All right, folks, part 2 from chapter 8. Now we're going to take a look at that alternative minimum tax. Okay, so basically this is a second round of calculations to ensure that you're paying an appropriate amount of tax. So you take the regular taxable income, right? Okay, then it says plus the standard deduction if the taxpayer deducted standard deduction and computing regular taxable income. So if they did, you have to add that back, okay? Then there's other adjustments, okay? And that's kind of a long list. It's not really something for this class. It's a more advanced type situation. But that gives you what's called alternative minimum taxable income, okay? And then there's an exemption amount, if there happens to be any. And then that gives you the tax base for the alternative minimum tax times the rate. And then you have the tentative minimum tax minus the regular tax will give the alternative minimum tax. Okay? And again, the purpose here is to ensure that enough tax is being paid. And basically it generally impacts people that have a significant amount of investments. Okay? A little bit about this technically. It says some of these are referred to as preference items and some as adjustments. They're just calling them adjustments here, but don't ask me why. I don't even recall. It's been a while, but some they call preference items. Okay, but to be simple, they're just calling them adjustments. Okay, and so what it is, it's an alternative, more inclusive income tax base. So that means they're adding back items. They're adding back deductions, basically. They're adding them back, okay? And why? It's meant to ensure that taxpayers are paying some minimum level of tax. By the way, who is likely to pay it and what makes them? I mentioned this before. Large amounts of capital gains. Remember, the capital gains rate's probably going to be 15, for these folks, be 15 to 20%, okay? All right, some items that are commonly added back to regular taxable income. Tax-exempt interest from private activity bonds. This is a little bit different, not something that's talked about too much, but private activity, they're non-governmental bonds, but like they're usually government, private sector accommodations, state and local taxes, and real estate taxes, okay? Those are the typical ones. By the way, here's the exemption amount, and there's a phase out. So anyway, if you're married filing jointly, here's the exemption. If you're married filing separately, notice it's half, and then head of household. And then notice this is the area that you would have to be making a lot of capital gains or over this, or anything higher. But that would be the amounts where typically you would wind up having to do this, okay? All right, switching gears, we're going to talk about FICA taxes. We've talked about this before, okay? 6.2% is Social Security, 1.45% for Medicare, and an additional 0.9% if you make wages in excess of $200,000, or $125 for separate, $250 filing jointly. Okay, the $168,600 limit applies only to the Social Security portion, okay, only to the 6.2%. By the way, there's some talk about eliminating this. Eliminating the limit, okay? So basically what happens is on your salary up to $168,000, you charge that 6.2%. Above that, it just stops. So they're saying, well, if you're worried about saving Social Security, why don't you just let it keep going for people that have that issue. Also, it does create a bit of a problem when you have multiple employers. When you have multiple employers each year, like I'll give you an example. Typically, when I was working at NC State, what happened was NC State doesn't know what UNCP is paying me. So typically they would take this money out and then it'd wind up coming back to me in the form of a refund because if I went over that $168,000 limit. Okay, so that can create some problem. It can create problems with other taxes too, because they're taxing you based upon what you've earned there, not what you've earned globally. Okay, and the employer matches this, and they withhold the items from, so it's basically 7.65 and 7.65, half from the employer, half from the employee. Okay, now self-employed people, okay, self-employed people responsible for the entire amount, so both sides, right? So what they do is they have a calculation here. It says you take schedule net C income, multiply by 0.9235, right? And that gets you basically the deduction that you should get. And the same limit applies to Social Security, okay? So basically what winds up happening is they wind up getting a deduction based upon half that amount. Again, we mentioned that before. That's about fairness. Okay. If you earn less than $400, no self-employment tax. So notice it says, how does the $168,000 if you have both wages and self-employment? Okay, so the question is, what happens? Wages use up the limit first. The reason why is part of the wages used up the limit first, and that's favorable for the taxpayer, because this way part of that other income coming in doesn't wind up going through that taxation. So wages use up the limit first, then money coming, and it's favorable. Okay, so wages first. Saves flow through income. Being taxed. Okay. All right. So here, let's take a look. Assume Courtney received $100,000 of taxable compensation, and she also got $180,000 self-employment. Okay. What about self-employment taxes and additional Medicare taxes Courtney required to pay on her $180,000 of business income? It says assume that Courtney's employer correctly withheld this amount of Social Security, that amount of Medicare. Okay, so remember, she's responsible up to 160 something, right? So here you go. First thing, 168.6 minus 100, so that's 68,600. Okay. Then the net earnings from self-employment, okay, times 92.35% is this amount. Now, what happens is Social Security portion of self-employment tax, what it says, lesser of step 1 or step 2 by 12.4%. So this would be 12.4% times that number right there will give you this. The Medicare tax, step 2, times 2.9%, and then round it off, that's 2.9% times, let's say 2.9% times this number. Okay, and then so the sum of the taxpayer's compensation and net earnings. Okay, so now what we're doing, we're taking their compensation, $100,000, plus whatever was in step 2. This is their total amount. Okay, so now we got this number right here, and okay, then we take the greater of 0 or this $200,000, well, up minus 200,000 times 9%, so that's 66,230 times the 9%. This is the amount over $200,000. You get 596. Step 6, any Medicare withheld by Courtney's employer, okay, still leaves 596. So the total is 3 plus 4 plus 7. So 13,923. 13,327 of self-employment taxes, and 596 for additional Medicare. Okay. All right, folks, I'm going to stop it right there. We're getting ready to switch over to another item. Be back in just a minute.